Hey there, everyone. Today on the final bar, risk-off positioning into the weekend. Defensive sectors at the top of the leaderboard. The S&P 500 closes below its 200-day moving average for the first time since March of this year. Finally, we'll open up the final bar mailbag, answering some of your questions from the last week. Ladies and gentlemen, this is the final bar. Hey, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com. Once again, not from a rainy Redmond, Washington, but from a very sunny and hot New Orleans, Louisiana. I'm here in town for FinCon, which is a gathering of financial bloggers and podcasters and YouTubers, picking up a lot of great ideas from other contributors out there around the U.S. and elsewhere about what sort of things that they're doing and what sort of content they're trying to create. Got us a lot of good ideas for Stock Charts TV, which we'll hope to implement here in the coming months. Just want to talk to you about today, the market overall in quite a distribution phase. We talked about through the course of this week, but really today kind of an exclamation point on the risk-off sentiment for investors, the risk-off feel to the tape, and certainly the risk-off trends that you're seeing. You're seeing stocks gapping down. Names like SolarEdge come to mind with pretty significant drops as they sort of ratchet down expectations big time for potential growth for their businesses, and quite a defensive feel in terms of the sector rotation. I think that's a key differentiator from what we've seen recently with sectors like technology at the top of the list. Today, it's more the pure defense, consumer staples, the top performing sector. We have a lot of things to talk about. Let's get right to our Wrap the Week segment, where we'll focus on how the markets have evolved through the course of this week, particularly with today's action. But let's get first to a poll question we asked you recently on our social media accounts and on our YouTube channel. So make sure you subscribe to our channel here on YouTube, give the video a like while you're there, and also follow us on Twitter and Facebook and elsewhere. We asked you recently, where will the 10-year yield, $TNX on our platform, where will it be 1 month from today? What's interesting is the 10-year right now is right about at 5%. So 5 to 5.25, 5.25 and above. Below there, down to below 4 3/4. And basically, the most common answer, although there's quite a bit of spread between the four, most people saying above 5%, about 68%, just over 2/3, suggesting that the 10-year yield would be higher from today. I would 100% agree with that. I would probably say above 5.25, although it's a question mark. And I think one of the issues that you're seeing now, as we bring up the chart of $TNX, is bonds often are a safety trade, right? So if things really get bad, if conditions in the Middle East really start to escalate and people are just looking for some safe haven to ride things out, I wouldn't be surprised if you get a bounce in the in bond prices just because of a flood that was happening. There's been a lot of flows away from bonds, which is causing yields to go higher. The opposite could certainly cause rates to come down, but I would say overall the trend clearly positive. Which you have to remember from a technical perspective, it's less about the why. It's less about why yields are moving higher, and it's more about the fact that they are. Because what I found talking with a lot of investors, a lot of strategists over the year, if you get caught up too much in the why, if you think about why yields should go up and have that be what defines your investment process, you will just be very unprepared when that doesn't happen. And I think what's great about a technical approach is it just focuses on the trends themselves. So for now, bond prices are in a confirmed downtrend of lower highs and lower lows. The TLT, the AG are going lower. Interest rates are in an uptrend. Looking at the $TNX, higher highs and higher lows. Think about lower interest rates when that pattern breaks, when we stop making a new high, when we start making a new swing low. That's what's happened with the S&P and the Nasdaq, right? That clear rotation now below the 200-day moving average. Thanks for answering the poll question. As a reminder, make sure you follow us on the socials and you won't miss the next poll question. As we continue to wrap the week here, let's look at what happened through the course of trading today, and then we'll look at some of the individual names on the list as well. The S&P 500 really getting crushed today, down about 1.25%. Honestly, that's not getting crushed. Getting crushed is worse than that, but this is still pretty rough. Down 1.25%, getting nearer and nearer to that key level of 4,200. We're just 24 S&P points above that level. And that's a level we've been talking about for quite some time. Certainly a potential floor in the market that comes from the February 2023 high. That breakout over spring into summer was pretty significant as a break to new highs really follow through to the bullish sentiment. But July, August, we topped out. Now we're rotating lower, testing the 200-day, testing 4,200. Many of my guests have focused in on 4,200 as a key level and or the 200-day moving average. So closing below the 200-day today, kind of an issue. We'll look at the chart of the S&P here in a minute and fill that in a little bit more. The Nasdaq Composite down about 1.5%, closing below 13,000. Mid caps and small caps all down about the same, to be honest. Not much of a difference between mid, smalls, and large caps today. And the mega cap S&P 100 down 1.25% as well. The VIX ending the day higher, going up just slightly, to be honest with you. And it was going down. It was lower earlier in the afternoon, in that sell-off in the last hour of trading. The VIX actually spiked higher to finish above 2150. So firmly above 20 for the VIX, now below the 200-day moving average for the S&P. This is that sort of bearish scenario we talked about, what it would look like. We're kind of there, and that's what I would encourage you to think about as you review the charts on the weekend, which hopefully you have a time over the weekend to do kind of a weekly review. That's where I would be focusing my attention. Now, interest rates certainly, overall in a trend moving upwards. Interest rates came down today. The 5, 10, and 30-year points all a little bit lower. The 5-year point came down the most. 10-year yield still about 4.9%, around 4.92. The long bond around 5.09%, just below 5.1%. Bond prices today moving higher. The TLT was up about 0.6%. Again, overall, the trends kind of the opposite of that. Trends have been higher rates and lower bond prices. No big change for the dollar from yesterday's close. Commodities actually a little bit mixed, but the sort of safe haven component, the precious metals and commodities were higher. Silver prices up 1.4%, and the GLD was up 0.3%. The broader commodity space was lower, and that's mainly crude oil prices came down. USO was down about 1.2% today. Cryptocurrencies all in the green. This is kind of an interesting head scratcher here. If you think about, cryptocurrencies as risk assets, which I would tend to agree. You think about how closely stocks and cryptocurrencies have been related here recently, which they certainly have been, right? Stocks overall moving higher has been sort of a risk off scenario, and cryptocurrencies have tended to do well. As stocks sold off, you also had cryptocurrencies moving lower. This week, kind of bucking that trend. Bitcoin briefly traded above 30,000 today and finished the day up about 3% from yesterday's close, currently around 29,600. Ether price is getting back above 1,600. We've been down in that 1,500 or so range for quite some time, sort of bouncing back up. So the crypto space actually moving higher into the weekend, while stocks, for the most part, obviously coming down pretty good. Looking at sector movements here very quickly, you can see, and I just have to highlight the fact that consumer staples at the top of the list, and it has been a rare moment here in 2023 and certainly recently in a defensive tape, right? In a market that's been going lower. It's been rare that we've seen the XLP at the top. Today's that day. The XLP, consumer staples, also healthcare, about tied for first, both down about 0.4%. After that, real estate, REITs were down 0.6%. On the bottom, technology and energy tied at the bottom of the list, both down 1.7%, followed closely by consumer discretionary, the XLY, which was down 1.6%. Let's look at the wrap the week chart, which we like to do on a Friday, and just look at the last 5 trading days. Think about what has happened. So we're starting the clock here last Friday on October the 13th. We go to today on October 20th. Boy, it's not lost on me that the markets really started to deteriorate on Friday the 13th. That's when the banks started reporting earnings. They were not particularly good that Friday. They also continued to be not particularly good through the course of this week. And earnings in general have not been great. There have been random wins, like Netflix, obviously an obvious win this week. But overall, earnings were not the upside catalyst. If you're a bull here and you're thinking earnings maybe are the big catalyst to pop things higher, you really didn't get that to a large scale. We'll see as some of the other Magnificent Seven names report. Maybe that could be enough market cap represented that could provide an upside catalyst, but for now, not particularly strong. Here's the S&P 500 in black. Finished the week pretty rough, down about 2.4%. I haven't looked at the tape on this one. I don't track weekly returns that closely, but this has got to be one of the worst weeks for the S&P in 2023. I would imagine probably top 3 or 4 weeks for negative, or bottom 3 or 4 weeks, I guess is the way to describe it. A couple things underperformed the S&P this week. Emerging markets really struggling. Oil prices coming off and really starting to have a tough time here, down 2.8%. Closely related to that, you have the Nasdaq 100 down 2.9%. That's the QQQ. In red, we have bond prices. The TLT finished the week down 5%. Not great. And again, higher rates mean weaker bond prices. So here's today's sort of pop in the TLT, but overall, you can see the trend has been down this week. Everything else kind of outperformed. The dollar, not much change this week, just finishing the week down 0.3%. In brown, we have crude oil prices up 2.2%, gold up 2.7%. And that emerging strength in gold, if you've missed that, hopefully you've watched the show and we've talked about this reversal, right? Gold, a rough chart here not too long ago, really reversing higher. And as events in the Middle East have started to unfold, have begun to escalate more and more, gold has sort of served its safe haven role that it often has not served in 2022 and 2023. It's kind of happening now. You're seeing gold prices rally. Bitcoin, the best of the bunch here, up 10.1%. As I mentioned, sort of a disconnection between a lot of risk assets, which finished weaker, and cryptocurrencies, which are actually having a pretty decent week here. Now, that's the setup as we go into this weekend. The challenge for a time like this with the geopolitical issues and a couple days where news flow could happen and the markets are not open, you often will get kind of a sell-off going in there. And it's usually sort of a dialing down the risk, getting defensive, just in case something bad would happen. A lot of institutions would, if you're managing short-term, trading, you probably go risk off as much as you can, just in case something horrible happens. You don't have a chance to, sort of adjust anything until Monday. So that's pretty common given the uncertainty of what's going on, spike in volatility, risk off sort of feel. And that's where I find these markets here going into the weekend today. Now let's talk a little bit about chart of the S&P 500, because we've talked about some of these levels here for a couple of months. We talked about the 200-day. Really, when we started to get this rotation, put in a lower high, it's like, well, how low could you go? And that's any media outlet that I appear on outside of Stock Charts TV, that's one of the first questions I'll get is some sort of prognostication about the S&P. What levels are important? What do you think? Where's it going to be at year end, or some arbitrary future date? And I try to stay away from that kind of forecasting, but I'm often asked to anyways to sort of give it. And the 200-day is a pretty logical place to focus in on, because as a long-term investor and thinking about the long-term trends, the 200-day is often sort of a pivot point for stocks, right? As long as the S&P or whatever stock or ETF you're looking at remains above a 200-day moving average, just things aren't getting that bad. And what I tend to think about, one of the things we talk about on the final bar is you sort of have your overall sense, your overall bias to the market, the trend that you see, and then you have some line in the sand or some level at which you need to revisit that thesis, right? And sort of the market is telling you that that's no longer the appropriate placement. And I would say the 200-day has been that for me, and certainly for a lot of other investors. We closed below there today. So how do you play this? Well, I would often said when you have a particular level like the 200-day, you close below it. Remember, that's like the initial trigger. Now you're looking for confirmation, which means Monday's session, I would argue, is going to be pretty important. We'll see what kind of news flow we get over the weekend. We'll see how the markets open Monday. And by Monday's close, do we see additional selling, right? If there's negative news flow, if there's expectation that this is just the beginning of events in the Middle East, or some other sort of, events occur that would, give an impression of more risk-off positioning for investors, we'll see that follow through, and a lower close or a lower low on Monday would really start to validate this breakdown scenario. On Monday's session, on Monday's show, we'll either be talking about this recovery as we bounce off of the 200-day, or we'll be talking about some further downside objectives. I'll have my pencil sharpened, ready to talk about some of those here on Monday's show. Let's go to a couple other charts here. We talked about breadth in pretty good detail on yesterday's show, so I don't want to go too much in there, but just to talk about the breadth conditions, of course, still pretty negative. So if you missed yesterday's episode, we did a whole segment called Banking on Breadth, where we dug into some of the breadth conditions. Make sure you check that one out if you missed it. I just want to show briefly the chart of Bitcoin now. 30,000, 3,100. This is sort of the levels that we've been talking about as key resistance. If you think about the chart of Bitcoin, it's really more of a rectangle here, right? There are periods on any chart where you're going down, making lower lows and lower highs, where you're in an uptrend or an accumulation phase, as I like to call it, where you're making higher highs and higher lows, and then a consolidation phase where you're basically going sideways. And anytime you can draw a rectangle around the price action, and it pretty much captures the visual, representation of that period, that tells me we're in a consolidation phase. And that's certainly what Bitcoin has been. It's traded below 25,000 on the lower end. See the lows in June and September, and then 31,000 on the upper end. So the April high was around 31,000. We retested that level in June and July. We're kind of right there. So we briefly traded above 30K. We're actually currently trading just below there, but 30,000 is a big round number. That's why I often like to talk about that one. I think to really make this chart a breakout chart with bullish implications going forward, 31K is the level that would get us above these highs in April and July. That would be a new high for the year. And that, in my opinion, would suggest lights out further upside potential and be assuming that the trend remains positive until proven otherwise. So Bitcoin's sort of an interesting chart right about now. Solar Edge, I mentioned, as we get to some individual names here on the move, gapping lower today. If you looked at their earnings report, kind of a cautionary tale about canceled orders and what sort of lowered expectations they're giving here going into next year. The stock getting beaten down pretty strongly, gapped lower to just below $80, actually almost down to $70 intraday. But by the end of the day, actually trading higher, got down to 72 actually today. But by the end of the day, actually getting back above 80. So you're seeing buyers coming in and buy in on weakness. The reason why I wanted to highlight this chart is, remember, the gap lower, obviously pretty painful. Look at 3 months ago, their last earnings report, you had another gap down. And then what was so interesting about Solar Edge back here in July into August is we gapped lower. And as we've talked about many times, gaps happen, and sometimes you may anticipate those, but a lot of times those are surprises. And that's just the nature of investing in stocks. You get gaps and they can be painful or they can be fantastic, depending on which side you're on. But when you have a gap lower, I think there's a lot to be said about what happens right afterwards. Do you see buyers coming in when the stock gaps from 240 down to 205, we'll call it, and trades a little bit lower? Do you see investors willing to buy in on that weakness? At that point, we were retesting the October 22 low. That didn't happen. You actually saw the price continue to go lower, which meant further selling, which means no real buyers coming in. That's been the story for the last 3 months. So while today's gap may have been very difficult to predict, the trend, I would say, very easy to define. And this is one of the many reasons why I describe why I don't buy new lows, right? Stocks making new lows are usually making new lows for a reason. I'm excited when a chart like this stops going down. Today's not that day just yet. We'll see what happens next weekend if buyers come in. This is obviously a big reset on the valuation of Solar Edge. TBD, to be determined next week. Just to finish off here, let's talk about a couple other names here briefly before we open the final bar mailbag. NVIDIA testing trendline support and really price support. If you look at the head here in early September around Labor Day, you have mid-July, the left shoulder, mid-October, the right shoulder. I don't know if we're really breaking down through this neckline, but we're right there, depending on how exactly, precisely you draw that level. I think we're right there. Now, what's interesting is if we do break through there, the measurement of this pattern, you take the height of the head and shoulders pattern, you subtract that from the breakdown, which really would suggest downside objective to the 200-day moving average. So not the end of the world, but certainly quite a big drop. That's another 70 points. That hurts, right? If you're owning NVIDIA, that might not be a move you want to participate in. So watch this level, I think, going into to next week to see if it's able to hold or not. Just to finish off there, I mean, is anything going up? There are a couple things. And one of the things I did was use our performance report. So if you go to any of your chart lists, instead of looking at a chart list like chart list view, click on performance, and you'll be able to look at that list of things based on their performance. I looked at the S&P for the stocks having the biggest gains over the last 4 weeks. Found a couple names, a defense name like Northrop Grumman, NOC, obviously gapping higher because of events in the Middle East. PXD, which is an energy stock, actually testing a new 52-week high this week. Both of those names selling off today, by the way, but showing some short-term strength. And Nike, actually one of the best performing stocks. Now, all three of those that I just showed you, all overbought. And I think that is a concern. Even the names that are rallying are sort of getting to that point where you might expect a bit of a pullback. I don't like this setup going into this weekend and certainly next week until proven otherwise. Certainly has a risk off feel to this tape. We're going to open the final bar mailbag here in a moment. Before we do so, a couple of quick announcements. First off, our mailbag is fueled by people like you sending in your questions. You have a number of ways to do it, and we would love to hear your questions. What are you running into as you're trying to use technical analysis, trying to use the stock charts platform, trying to make sense of these markets in uncertain times? Our email is thefinalbar@stockcharts.com. On X, just tag us in a comment at finalbarsctv. Of course, on YouTube, you have a couple choices. We have a live chat going anytime we broadcast the show live like we are today. Just pop a question in there. If we can get to it during the broadcast, we will. Otherwise, we'll put it in the mailbag and we'll get to it as soon as we can. You can also put a comment below any of the videos on Stock Charts TV's YouTube channel. We'll capture those as well. Also, send us an email, thefinalbar@stockcharts.com. That's the best way as always. Also wanted to let you know about an upcoming webcast coming up next Tuesday, October 24th. I'll be doing a webcast called Another October Low ? And the question mark is very much a part of that title. I can't tell you for sure whether we're going to have another October low, but I will certainly try to equip you with the tools you need to try to make that assessment as we go through the fourth quarter. Fourth quarter tends to be seasonally pretty strong. The conditions right now are pretty weak. So we'll talk about that push and pull. We'll look at some previous years where we actually have sold off in the fourth quarter and talk about some of the conditions we might want to look for. To sign up for that free event coming up next Tuesday, go to marketmisbehavior.com/October low, and I'll look forward to seeing you for that free webcast on Tuesday, the 24th. All right, let's open up the final bar mailbag. As a reminder, thank you guys so much for sending in the questions. Thanks for using the chat here on YouTube. We're excited to use more interactive live components on Stock Charts TV. We'll hope to do more and more of that over time. And let's get to the first question. Dave, could you please explain your chart of the small caps versus large caps? This came up, I forget what show this was that we got this question, but you were referring to, and you sent the link to the chart in the Mindful Investor live chart list. And again, for those of you that aren't super powerful or super comfortable using the Stock Charts platform, I learned a lot from asking questions from power users. And for me, my Stock Charts mentors were people like Greg Schnell, Tom Bowley, Arthur Hill, who else? Like Martin Pring always had some really interesting charts that told good stories. Grayson Rose here at Stock Charts, of course, as well. And those guys really helped me think about how to set up my login, how to really take advantage of the power of the platform. So if you're looking for a way to get things set up, you are welcome to use my Mindful Investor live chart list as a starting point. To get to that, by the way, just click on the articles tab on Stock Charts. In the upper right, you want to go down to my blog, which is called The Final Bar. Oh, sorry. It's called the Mindful Investor is where I have this link. And then at the top, there's this gray button that says live chart list. That'll give you to a live version of these charts. Just click on this green button to save it to your own login. Then you can customize them, tweak them, do whatever you like with them. But getting back to your particular question, let's go to this chart, which is small caps versus large caps. So there are a number of different ways you can think about market breadth, right? And I would think of this ratio in particular as a measure of market breadth. What market breadth is trying to do is, okay, the index is doing something, right? The S&P or the Nasdaq, whatever my main benchmark is, has a certain appearance right now. But what about the stocks that comprise those indexes, right? How can I look underneath the hood of the market or look at the details, all the individual stocks, and what kind of additional color can I get by understanding the trends that those different stocks are looking at? And there are different ways we can do this. We can look at breadth indicators like advanced decline data, or derivative indicators of advanced decline data like McClellan oscillators, or stocks above a moving average or something like that. Those are all ways of literally measuring, counting how many stocks have certain conditions. Or we can look at a series of ratios. We can look at an equal weighted S&P versus a cap weighted S&P, which basically means instead of overweighting the mega cap stocks, let me equal weight all 500 names and see if I can tell anything different. We can also look at small caps versus large caps. So small cap stocks like the Russell 2000, the IWM is a Russell 2000 ETF I would start with if you're not really familiar with the space. These are 2,000, kind of small to super small companies. There's a huge kind of survivorship bias in this index because the smallest names in the Russell 2000 are kind of sketchy, is the way that's my official financial professional term for some of the smaller names like the Nasdaq Composite. The smallest kind of smaller names in the Nasdaq Composite are pretty rough, and they may not really earn the ability to really should not be listed, I guess, is the way I would think about it. So keep that in mind. But small caps versus large cap basically tell you the higher beta, higher risk, sort of smaller, less proven companies. How are they doing versus the more established Apple, Microsoft, Walmart, ExxonMobil types of names. In general, in a bull market phase, the smaller stocks tend to do better because investors are willing to take on additional risk. They see the environment as positive, which means the chances of smaller companies really growing into large companies is much higher. So you're willing to take a shot at an unproven name. When things start to get concerning, you don't want to be taking risky bets. You want to get a little more conservative. So you go with the, big names like Alphabet, one of the leading names in 2023. You go to defensive stocks like Johnson & Johnson or Coke or Pepsi or, those sorts of staple type of or blue chip companies that are probably going to ride out periods of uncertainty. What's interesting is small caps actually have been underperforming for quite some time, right? And going into the end of the first quarter, mid second quarter, stocks rallying, but small caps still underperforming. Now that changed it a little bit. And if you look at May, June, July, going into the July-August market peak, you actually saw this ratio start to go up as investors maybe were starting to take on additional risk. That went back in a big way away from small cap stocks. I see this latest move as very much a risk-off sort of sentiment. I think this is a continued gravitation into the mega cap names, into the more defensive areas of the market. I think it lines up with increased volatility, which is another question we'll answer here in a moment. So that's how I would interpret this. In general, small caps outperforming large caps tends to be a good sign of additional risk taking by investors. It tends to be a good sign for the markets. This chart, as you can tell, has been trending down for quite some time, really suggesting not a great opportunity to take on super risky bets in the equity space. Next question. When do you favor EMAs as opposed to SMAs? And of course, you're talking about exponential moving averages versus simple moving averages. This came from Drew on the final bar Tuesday of this week. So Drew, thanks so much for asking that question about the two. And I would say there's a place for both in my opinion. I think some of my technical analysis peers are very passionate about one type versus the other. I'm a little more, I think there's room for all of us in my thinking of moving averages. I think they have good uses in different places. For an average, I'm bringing up a stock and I just want to see what Alphabet looks like. The 50 and 200-day moving averages, simple moving averages are what I use. And this chart is literally, if someone said, what do you think about Alphabet? I would bring up this exact chart and we would start the conversation. And maybe I would bring up additional things to sort of qualify or, add additional color. But this is my main go-to chart 90+% of the time. And the reason why I'm looking at price and the 50 and 200-day moving averages is because I've worked with a lot of investors in different roles, individual investors, big institutional investors, financial advisors. Anyone that uses charts, they probably have the 50 and 200-day moving averages on the chart. It's as simple as that. A lot of investors like William O'Neill always talked about the 50-day or the 10-week moving average. So I like looking at something like that I know a lot of other investors are using as a main measure of trend and risk. The 200-day moving average, most buy-side trading desks I've ever been on, they know where the 200-day is because they want to think about where we're at relative to that key long-term moving average. So I like having an awareness of charts and signals that I know other people are paying attention to. Now, if you were saying, Dave, can you create a trading system based on moving averages? I would immediately go to exponential moving averages, because if you think about what is a better measure of trend, what is more sensitive to trend reversals, and probably a better way of recognizing the importance of more recent data versus data a long time ago, exponential averages are far superior. So my market trend model, which is that first chart on the Mindful Investor live chart list, is using weekly data and using exponential moving averages. By the way, today, no change, still short-term bearish, medium-term bearish, long-term still bullish. So my model's still saying basically risk off on my time frame, which is that medium-term time frame. So overall, that is how I designed my market trend model. I didn't think much about that. When I thought about what this was going to do, I immediately went to exponential moving averages because they're a better measure of trend and a more sensitive measure of trend reversals. And that's why I think they're pretty helpful. I've done a couple of videos. I don't remember how many we've done on Stock Charts TV, but on my channel called Market Misbehavior, if you go there, I know we've done some videos talking about simple versus exponential moving averages and why one may be better for your particular purposes. Thanks for asking about that, Drew. Next question, who does swing trading and how long do these traders typically hold a position? And you went on to clarify a little bit more, like who are the players, right? Who are the participants who do swing trading and how long do you hold a position? What does that really mean? It's interesting, and I think there are, those sort of generalizations. It's really more general categories of investors and what they're trying to do. When I think about the average swing trader, I'm probably envisioning an individual investor who's really trying to trade in a time frame of a couple days to a couple weeks. More than a week or two is probably beyond the swing trading time frame. That's something I describe as more of a position trader or more of a medium-term, long-term investor. It's really where you need to stop calling someone a trader and more an investor, more of a long-term, thinking about long-term trends and shifts. Anything shorter than like a day or two, I would think of as more of a day trader, right? Someone who's really trying to, anticipate short-term price reversals, intraday types of moves. Swing traders are really sort of capitalizing on a couple days to a couple weeks. That's the general time frame that I would look at. And for me, the short-term model is really trying to focus on that swing trading time frame. That's the shortest that I really tend to think about trends and reversals. What kind of chart can we look at? I would say, even it really doesn't matter. I mean, anything like maybe Alphabet actually is a pretty good example of this. So if you think about Alphabet, right, and look at the chart of the last 2 years, think about the overall trend, long-term trends on this page, I would say in two categories, right? You have a downtrend in 2022, you have an uptrend in 2023, right? And you can tell that because the highs and the lows are going higher here, the highs and the lows are going lower, generally speaking, on the left. And so that's sort of that larger trend. But remember that this trend in 2023 isn't just a straight line from $87 a share to $147 a share. It has peaks and valleys, right? It has that short-term swings, moving up, moving down, and sort of these little sort of interim swings up and down. That's the swing trading time frame, right? These little components on the daily chart that comprise these longer term trends, right? Think about that big trend. Think about what these moving averages are telling you about the direction, and then think about the little peaks and valleys. When I say higher highs and higher lows, it's those peaks and valleys that we're talking about, I would say, on a swing trading time frame. What's interesting is the types of indicators you can use, I would argue, very similar. Just a lot of times you want to make them a little bit shorter term. So I'm doing a 14-day RSI because I'm trying to just think about the phase that the trend is in and just look at the overall larger trends. And that's how I'm using an indicator like RSI. But if I was day trading, I'd do like a 9-bar or maybe like a 5-bar RSI, because I'm just trying to identify when we're overbought and expect a brief pullback, when we're oversold and we might expect a brief pop higher. And I'm just trying to identify these short-term swings, so I just want to be able to sell here, buy there, sell here, that sort of time frame. So something like an RSI on a shorter, like a 9-day, a 5-day, that is how I would probably use something that's an indicator I would probably start with to think about some of those trends and shifts. And so that's how I would describe the swing trading time frame. That was just a couple minute description of what is done. Maybe we can have some additional episodes or content really focusing on swing trading and what type of tools you may want to use. But that is how I would describe that methodology. Thanks for asking about it. Next question. What is the MOVE index and how do we interpret it? That came up with some of my guests recently. I forget who most recently mentioned the MOVE index. So I can't remember exactly who that was, but I do know it came up on the show here a couple of times in the last month or two. So the MOVE index, and I actually thought I had it on the Mindful Investor live chart list, but I don't. So I do have it in my sentiment chart list for sure. So the VIX, if you know the VIX, which I hopefully you do because we've mentioned it often on the show, the VIX above 20, obviously, I think a key takeaway from this week as you're sort of licking your wounds and thinking about what we learned. The VIX getting above 20, I think, is an important data point to focus on. The VIX is on the bottom panel here in purple. On the top in black is the MOVE index. So what is the VIX? All right, if you know the VIX, then the MOVE is pretty easy to make sense of it. What is the VIX? The VIX is a measure of volatility. It's a measure of volatility using options. So it's actually an implied volatility, basically, which is looking at options and then implying the volatility in the underlying instrument, in this case, the S&P 500. So what the VIX does is it measures volatility of different index options for the S&P, and then it calculates this indicator. Now, the value itself actually has a meaning, but I found that meaning is pretty irrelevant to most investors. So I would just tell you a low VIX means low volatility. It also means low uncertainty, low fear. A higher VIX, an increasing VIX, means higher volatility, higher uncertainty, higher fear. So, more volatile an instrument, the more it's moving. So when you are sort of slowly riding a trend higher, volatility is usually pretty low because you don't panic buy, right? You sort of slowly accumulate. When you panic, when you get nervous, you tend to sell quickly. That's why Ralph Ickenpour, one of my mentors, always used to say the market goes up the stairs and down the elevator, or up the escalator, down the elevator is how it's also been said, right? So you go up slowly, you come down That's how markets tend to reverse. So higher volatility is an important measure of additional fear, and usually more of a sign that things are getting more risky, and you probably want to take some bets off and ride or be prepared for some market dislocation. That is what the VIX is for equities. The MOVE is everything I just said, but for the bond market. So it looks at options in the fixed income market and basically does that same calculation. So the higher the MOVE index, again, I wouldn't pay as much attention about the individual values. I would just say the higher the MOVE, the more the volatility in the bond markets. And the fixed income markets, honestly, tend to be a better gauge of risk overall, because I found that bond investors are very focused on risk because it's all about a company or a government being able to meet their debt obligations. So they are very keen on risk measures. Equity investors tend to be more excited about hitting home runs and growth and things getting better and better. And so they tend to be a little under-focused or underappreciate the importance of focusing on risk. So the VIX moving higher, the MOVE moving higher here in the last 4 weeks, I think same thing, showing you sort of a risk-off feel in the equity and the bond markets. Great question, by the way. Final one, are there prerequisites or certain experience needed to obtain or sit for the CMT? So the answer for that is yes and no. The CMT, as you know, probably you've seen it at the end of my name, stands for Chartered Market Technician. Many of my guests have the CMT and another designation, the CFA, which just Chartered Financial Analyst. These are professional designations in the financial industry that after you take a series, you study a ton, you take a series of exams, you pass a professional requirement, which is kind of important to your question, which means you have to be in a role where you're making investment decisions using the toolkit. Then you can get that designation. It's a professional designation you're allowed to use after your name. A lot of financial analysts, financial planners, fundamental analysts, money managers have the CFA, which is kind of a fundamental analysis designation. A lot of technical analysts, traders, and others who use charting in a professional method have the CMT, and that's what that stands for. So can you sit for the CMT exams? Anyone can. You can actually join the CMT Association as an affiliate member, regardless of what you do. And if you're just trading on your own and you have no aspirations to be in the financial industry, you can be a part of the CMT Association. You can attend events. To get the CMT designation, you have to pass the exams. And again, you can take them. And I've actually seen college students taking their CMTs as a way to sort of get ahead of the game and then see if they can get the professional experience later. To actually obtain the CMT designation, you have to have sponsors who can validate your professional experience. So it is really intended more for professional investors, someone working for a financial firm that would need that CFA or CMT. For more information, you can go to cmtassociation.org. I'm sure they'd love to tell you more details about the CMT exams and what all is included. Great questions, by the way, and all of those came from email, a couple of them from this show earlier in the week, one from the live Q&A on Monday's show. So keep the questions coming, and thank you guys so much for making this an interactive experience. We got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We talk about the MOVE and the VIX, and thank you so much for asking about the MOVE index. It's something that's become, it was created years ago, but really has become more popular recently because, and it really became popular in February and March when it spiked up so high, and it was like the MOVE made a new high. What does that mean, and what is the MOVE index? Now it's become something that I know a lot more investors have been watching. And again, just think of it as the VIX for bonds, and in either case, increased volatility implies increased uncertainty, which means increased risk, which means you probably want to take some risk off or at least be prepared for further downside movement in the asset classes that we're thinking about. Both of these indicators have had a strong 4 weeks, which means VIX and MOVE going higher, volatility increasing, uncertainty certainly not getting any easier here. Chart number 2, the name exposure index. Shout out to our friend Tony Dwyer at Canaccord Genuity. He's been a friend of Stock Charts TV and a frequent guest on this show. He's a fantastic strategist, one of the best that I've known. And he actually highlighted in a note just today about the name exposure index spiking higher. The name exposure index stands for the National Association of Active Investment Managers. This is a survey of money managers and what their allocation is to the equity markets. Just 2 weeks ago, it was down around 35%. Last week, spiked up to around 45%. Today, finishes the week around 67%. So what this is telling you is actually money managers appear to be buying into this weakness here in the short term. So it's sort of disagreeing with some of the evidence I think we've seen with the VIX increasing, with a lot of stocks breaking down. This is suggesting that some of the quote unquote smart money, at least represented by this poll, are actually going a little bit risk on going into these lows. And that might be an important indicator to watch here in the next couple of weeks, as certainly as macro events continue to evolve. Finally, great question about simple versus exponential moving averages. As you probably know from watching the show, I'm a big fan of keeping things simple. I like things that are easy to explain and easy to understand and easy to use consistently, because that is way better than a really perfect but really hard to use process. Why is it so important that the S&P is testing the 200-day? This is looking at the last, I think, 10 years, 10 years of the S&P 500 in purple. We have the 200-day simple moving average. The reason why we focus on that so much is look at during the bullish phases in 2014, 2015, in 2016, 17, 18, here in 2019, certainly in 20 and 21, all those times when we've been above the 200-day moving average. That's when bullish trends happen, because by definition, we're above that longer term trend. When we start breaking below the 200-day, that's when, like, late 2018 or early 2020 or all of 2022 or mid 2015, that's when those things can happen. And that break of the 200-day is rarely the end. That's usually the beginning of something starting to deteriorate. So whether the S&P can hold the 200-day now, pretty meaningful. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close. Thanks for hanging with us as we do things remotely from New Orleans. We'll be back in the studio, hopefully safely, on Monday, and look forward to doing a live Q&A there as well. Don't forget about our sister channel called Stock Charts. A lot of great documentaries, a lot of information about the Stock Charts platform. Grace and Rose sharing some tips and tricks. Ralph Eckenpour's recent presentation just posted on there as well. You can see that from our YouTube channel. Just click on the other channels related, and you'll find it there. For StockCharts.com, today in New Orleans, Louisiana, I'm Dave Keller. Be well, stay safe. Have a good weekend. We'll see you on Monday.